Ever wondered how the financial markets work or what derivative trading is all about? Well, today, you're in for a treat. We're diving deep into the heart of finance, breaking down complex terms and concepts into simple, understandable language. Let's start with a question. What are financial markets? At the most basic level, they are where people trade financial securities and commodities at low transaction costs. These include stocks and bonds, currencies, metals, and derivatives, such as options, futures, forward contracts, swaps, and more. So what exactly is a derivative? In simple terms, a derivative is a financial instrument whose value is derived from an underlying asset. These assets can be stocks, bonds, currencies, or commodities. The price of a derivative is directly dependent on the supply and demand of the underlying asset. To put it simply, derivatives are contracts between two or more parties that derive their value from an underlying asset. They are primarily used to hedge risk or for speculative purposes. Options, a type of derivative, are contracts that give the buyer the right but not the obligation to buy or sell an asset at a specified price within a certain time. They're akin to insurance for stocks. They let investors hedge risk. The buyer or holder has the right but not the obligation to trade. They can choose, hence, options. They react based on market movements. The agreed price is the strike price, and the expiration date is when the option can be exercised. The buyer pays a premium for this right. It's important to note that options carry a high degree of risk. The buyer could lose the entire premium if the price of the underlying asset doesn't move in the direction they anticipated. On the other hand, the seller of an option could face unlimited losses. The value of an option's premium is influenced by factors such as the time until expiration, the strike price agreed upon, and the volatility of the underlying asset. Options are traded on regulated financial markets, providing transparency in prices and trading methods. There are two basic types of options: calls and puts. A call option gives the holder the right to buy an asset at a certain price within a specific period of time. A put option gives the holder the right to sell an asset at a certain price within a specific period of time. When you buy a call or put option, you are known as the holder. The maximum loss you can incur is the premium you paid. There are different strategies for buying options, depending on whether you have a bullish or bearish outlook on the market. If you're bullish, you might buy a call option, expecting the price of the underlying asset to rise. If you're bearish, you might buy a put option, expecting the price of the underlying asset to fall. In conclusion, derivatives and options are complex financial instruments that allow investors to speculate on the price movement of underlying assets or hedge against potential price changes. They carry a high degree of risk and require a deep understanding of the financial markets. Always remember to do thorough research and consider seeking advice from financial advisors before diving into options trading. This report is brought to you by Kwawamiz Financial Services. At Kwawamiz, we are bringing financial transparency and education to all financial users over the world. Please share, follow, and like our channel.